right. Hello, everybody. How's everyone doing out there on a Thursday afternoon? Woo! Yeah, Zero Expo. Nice. Shout out to the crew for staffing, for running this event. Really excited to be with all today. So as we start off with, we are having our second roundtable focused on MEV. So we had one earlier this year before we transitioned to proof of stake, and now we're in this proof of stake world and have started trialing this proposed builder solution. So we have this awesome panel with us today from different individuals across different layers of that MEV supply chain. So we'll get a different perspective. We'll get different perspectives on how this state of the world is doing now. So to get us started, let's do some guest introductions. So please introduce yourselves and a little bit about what you work on.
Sure. Good afternoon, everyone. My name is Matt Cutler. I'm founder and CEO of Blocknative. Blocknative builds a real-time infrastructure for the pre-chain layer, sort of everything involving transactions between the time that they're an idea and they go on-chain. We've been doing this for 4 years, and along comes the merge and proposer-builder separation and block building, and now we're one of the leading block builders on Ethereum. We operate a relay called Dreamboat, and we're out there competing every single day to bring transactions on-chain to validators.
Hello, everyone. I'm Robert. I'm a data scientist at 0x. We look at MEV at 0x as it touches our users, and we actively try to mitigate it, and we'll share what we found out.
Hello, I'm Alex. I'm marketing manager at Cow Protocol, which is the underlying protocol that powers CowSwap, which is your favorite DEX aggregator that offers you MEV protection. Oh, sorry, your favorite meta DEX aggregator that offers you MEV protection, and we do it through the use of batch auctions.
Okay, great. So we've been using this term MEV. I just want to know out there, raise of hands, who knows what that term means? Okay, so about 50%. So then with that, Matt, could you give us a quick introduction of what is MEV, kind of overview of why is it something we're talking about, and then also what is this supply chain we've been alluding to?
Sure. So real simply, MEV is the value that can be extracted from an ordered transaction system by altering the order or inclusion or exclusion. That's it. That's the whole thing, right? Now, it turns out all transaction systems are ordered systems because you can't have a transaction system without ordering. So believe it or not, MEV is a fact of life for all transaction systems. Stock market, credit card, title, and Web3 systems and blockchain. The difference in Web3 systems is it's more open and exposed and programmable, so we know more about it. And the reason why it's really come to the fore right now is with the merge, the rate of issuance of new ETH for each validator has come way down. It's the triple halvening. And the reason for that is with the merge, you don't need specialized computers and you don't need a whole bunch of power, which is awesome. So the rate of issuance goes way down, which is great for the supply of ETH. But as a consequence of that, the amount of value per block that MEV constitutes has gone way up. It's not that the amount of MEV has gone up, but the relative proportion of MEV has gone up. And this becomes a centralizing risk as you have certain validators who get better at that. They create more profitable blocks. They offer more yield. They get more stake. They propose more blocks. They get more yield. They get more stake. And so before you know it, MEV acts as a sort of under-the-covers centralizing force for validators. Well, in response to that, the Ethereum Foundation partnered with a group called Flashbots to introduce what's sort of known as proto-PBS, or proposer-builder separation, through a sidecar called MEV Boost. And what basically that does is break apart the act of building a block, i.e. what transactions go into a block, from actually validating it to the network. And there's a whole sequence of providers who start with the user and goes all the way to the validator. That's called the supply chain. And historically, what happens is MEV rolls downhill. So user starts with a transaction, goes to the public mempool, searcher picks it up, creates a bundle, gives it to who's ever building the block, and they receive all the value. So the user starts with the transaction, but they're not aware, nor do they participate with the MEV. And there's a bunch of actors along the way that create MEV and then extract value from it. And historically, that's sort of rolled all the way downhill to the end where the miners took it out under proof of work, and now the validators are taking it under proof of stake. But there's a lot that goes into MEV, and there's different types of MEV, and there's various ways to mitigate or protect against MEV, which I think we'll be talking about today.
Cool. Yeah, thanks for that overview, Matt. So then to Robert. So you're talking about, we had 0x, we had been looking at some MEV mitigation solutions, but maybe one step back, I want to talk about, what does MEV look like when it affects a user? So there's this thought about slippage exhaustion that you had looked into earlier this year. So can you explain what that is, and how does this affect end users?
Right. So we do DEX trading. So these are examples that related to swapping tokens. So to take a step back, maybe we should understand first how these things work. So there is a user. He comes to his favorite DEX aggregator, and the aggregator prepares the transaction. The user signs this transaction, sends it to the mempool, and then bad things might happen. User gets a bad price. His transaction slips. The user actually loses money. So what we did is we actually looked how often it's happening, why it's happening. You can quantify and measure this stuff. And we found out that our users, it's just 0x. There are other places, other venues on the blockchain where people trade. And our users lost, it's over 8 digits just this year due to slippage. And we should do something about it. Basically, what's slippage? Just to explain, you go to a website, you go to UI. I want to sell 100 ETH or 1 ETH, doesn't matter. You get the price that you'll get, or at least the price that's quoted for you. And then you submit that transaction, you check what happened, and you did not get that price. You got something worse. And this is something we try to fight with, like to make actually the quote you see, the price you will get. And it's a complicated process, and we will discuss a bit more about that.
Yeah, so essentially we've been talking about like all these different actors and how MEV affects, kind of starting alluding to how MEV affects different actors here. So for the next couple of questions, want to understand different solutions that the different products are looking at. So starting uphill we're going to say is the user, starting with the user here. So back to Robert again. So what then did 0x do? Kind of leading question, but perhaps slippage protection is something that we'd like to talk about. What is slippage protection that we? So sorry, let me rewind a bit. Slippage protection, we released earlier this year, and can you tell us a little bit about that?
Right. So actually, I think we have a good team here because we have this supply chain where there is a wallet, then there is a searcher, there is a builder, and you can think the other way. There is an app, then there is a protocol that this app is built on, and there is a block builder, and you can try to mitigate MEV on all levels of that stack. So we have an app, 0x API, and ourselves, what we did, you can hear, for example, about MEV redistribution, how to share the profits with the users. Like, we're not there, but we can actively try to mitigate this. So what we did is, like, as I already mentioned, we analyzed the data and we actually got to some conclusions. Like, these things should not happen. We knew a priori that this transaction will go bad. And what we do is we built a model based on historical data that tries to anticipate what is actually going to happen and include it in the routing. So the users that come to a DEX aggregator, which is actually a good thing, because when you come to a DEX aggregator instead of Uniswap, for example, you can get better routing, or you can split your orders at various venues to get better price. So when you come to a DEX aggregator, you click you want to trade something, usually some algorithm will find the best path for you. And we just tweak that algorithm so it gives you paths or trades that would slip less. It sounds very simple, and it is simple, but actually the users, they have no idea usually what's happening under the hood, and it's important to do this work for them. And we kind of try to make their experience better without even them knowing that it is better. So we build that model, it proposes a path that anticipates what the slippage will be. We have another completely different part of our stack, which is called request for quote system, which our private market makers can fill the orders that users want to, complete the trades that our users want to trade. And these orders, they're special because they don't have slippage. There are two parties that actually sign a transaction before, and they agreed on everything. No automated market makers are being used, and these things don't have any slippage. It's just agreed upon. And our solution uses that also as well. We can decide if a given transaction is at risk, and if we think it's at risk, we will just send it somewhere else, so it doesn't suffer any slippage. So that's the first step. There are other things we can do, and we're actively working on this.
Yeah, so thanks for that overview of slippage protection. Then let's pass over to Alex. So, we haven't heard from you yet, but can you tell us a little bit about COW? So COW protocol, what is the thought process behind it? Yeah. Let's go for it.
So basically, COW protocol is a thin batching layer on top of all the AMMs and all the aggregators existing today in Ethereum and as well in Gnosis chain. And this batching layer, what allows us to do is to aggregate multiple trades together and execute them in a single Ethereum transaction. But the cool thing about it is that because we work with batch auctions, we kind of transform the way the user interacts with a DEX. So instead of the user kind of crafting the transaction and sending it directly to the mempool, what the user does is sign a trade intent. And basically this trade intent then allows us to optimize in which way should the trade kind of be settled. And because we use batch auctions, it also allows us to do many cool things like coincidence of ones, which is actually why the name stands for, COW swap or COW protocol, which are peer-to-peer trading. That if someone is buying and another person is selling in the same batch, then we can match them completely peer-to-peer, and then the trade kind of becomes a transfer instead of having to go directly to the AMM. And from there, it's completely non-MEVable. But the cooler thing is that these batch auctions are completely run in a decentralized competition where there are these three layers that we call solvers that compete against each other to find the biggest price improvements for the users. So basically, these solvers will look at the orders within a batch auctions and will optimize those trades to give them a maximum profit for the users, so the best price improvements for them. And the one that actually finds this price improvement like at the biggest is the one that gets the right to settle the auction and then gets rewarded from the protocol from doing so.
Okay, interesting. So I saw that in your talk at DevCon, you mentioned the idea that COW would be interested to, these searchers that are in this ecosystem, they're finding transactions and proposing them to the builder, finding opportunities and letting the builders know, converting these searchers to COW builders. So, what is the thought process behind that? What does it take for this to happen?
So basically, the idea is that for us, or at least for me, but no, also for us, it's kind of a searcher and a solver, this relayer that I mentioned before. They're kind of two sides of the same coin because they're both bound by an auction competition, but they both kind of algorithms that optimize a bundle of transactions. And they're all competing against another network of parties that are competing against them. And they have to compete to optimize the transactions in the way that creates the most value. The slight difference in our case is who is this value creation awarded for. In the case of searchers, it's for validators or stakers, but in our case, it's for the actual users that create the opportunities themselves, which are the traders. And also the difference is that in the case of searchers, they're maximizing to extract the value from the users. And in our case, the solvers are maximizing a function that's minimizing the value extraction from the users. And the way we see this is kind of like if we split it in the short term or long term. In the short term, ideally, we would work with block builders, so to ensure that our batch settlements land in the correct place of the block, so that we can even give better prices for the users. And this can be two ways: either if we are in the first transaction of the block, then basically all the trades that are happening within that settlement are completely arbitrage free because we enforce uniform clearing prices in the batch auctions. And then another way that that can work is basically if the builder kind of like, I guess, altruistically works closely with us so that they insert transactions in a way that we're even able to improve the prices more for the users. But the goal is that for the long term, we are able to capture enough order flow through Crowd Protocol so that in the end, like all the MEV that kind of like hits now the mempool is reduced. And if we're able to reduce all the MEV at the application level, then kind of the block builders don't need to focus on this game of extracting value from users and kind of like hurting the users of Ethereum, but rather focus simply on, again, on just like building the block in the most profitable way based on the tips. And if Cow Protocol is able to capture a big of enough order flow, then the servers will get more rewards, and they will also be able to pay a higher fee for them, and then which will mean that they're like higher rate for inclusion of those transactions.
I see. So like a very like altruistic form of way of looking at how the system could shift towards. Nice. So maybe let's transition over to the block builder's perspective. So Matt, now that we're in this proof of stake world, I know Blocknative has started running your own relayer, so Dreamboat relayer, and then you're also in the field of block building. So thinking about like what does it take for PBS to like move in protocol, right? Right now it's kind of this trial, this thing that the ecosystem's like trialing and seeing how we can improve on. But maybe first let's talk about what's working well so far, like being a player in this space.
So it's pretty amazing. I mean, the merge went off without a hitch, which was an amazing technological achievement. Hats off to the devs who made that all happen. But simultaneous with that, this whole new market of block building emerged, and that is operated largely without a hitch too. There've been a few hiccups, but nothing too bad. And so you had the massive upgrade of the network and transition to proof of stake, and you also had like a fundamental rewiring of how blocks get constructed and who's a party of that, and that works pretty well. Now, it's done using this sidecar called MEV Boost, and there are a number of trust assumptions which are required as part of operating this, including at the relay level, and this is where some of the hiccups are. And so on the Ethereum roadmap, and again, I always like to say this, which everyone thought the merge was the destination. The merge is just the milestone. You have the merge, and then you have the surge, and then you have the verge, and then you have the purge, and then you have the splurge, okay? And as part of the splurge, the very tail of that is what's known as in-protocol PBS. And the only thing you need to do in protocol PBS is a whole bunch of research and a whole bunch of time. Because it turns out that we don't really know how to do in protocol PBS, really. And so it's sort of like this MEV boost thing, this relay, these trust assumptions, this is a big hack. You should just do the real thing. And you go, except nobody really knows all the missing pieces there. So the reason why in protocol PBS is further out, and I think the last estimate that Vitalik gave is somewhere between 2 and 8 years away. So it's not tomorrow. It's not the day after tomorrow. We're going to be living in this regime for some time. That MEV boost and relays are a fact of life. And so we're discovering right now what the possibilities and you of that reality is. And literally every day something new and exciting happens, including this morning for us, which is kind of exciting. And so you can watch this play out in real time. And the good news is it's very transparent. There's tons of dashboards about what's going on with MEV Boost and the block building and relay market. There's tons of discussion, community, open source code. I mean, if you want to get into this stuff, there's tons of opportunity. We're hiring like mad. If you're a back-end dev, we'd love to talk with you. And so that makes it super fun. There is some concern about centralizing forces at play at the block builder level. And believe it or not, this was foreseen and perceived as a better outcome than centralization at the validator level. So the problem with centralization at the validator level is all the ETH accrues to a small number of actors, and you can kind of never undo that. But if there are some centralizing forces at the block builder layer, there's future changes you could make that would kind of unwind that. And so believe it or not, that was kind of like the lesser of two evils would be, risk builder and relay centralization in exchange for avoiding validator centralization.
Oh, interesting. Can we dig a little bit more into that?
Sure.
Oh.
So what's the issue here is it turns out that block building is hard, that you need a whole bunch of very specialized expertise, you need a whole bunch of compute, you need a whole bunch of network access, you need a whole bunch of data, you need to move stuff around at low latency, you got to solve all sorts of problems in real time. And it turns out that not very many people know how to do this, and this is something that like requires teams with funding, and so what winds up is there's not that many block builders, and there's not that many block builders who run relays because all this stuff is hard and expensive. The idea is that there will be a vibrant economic incentive model here that makes this whole world turn around. That hasn't shown up yet. That the vast majority of blocks that are built by block builders have 0% margin, meaning if a builder proposes a block to a validator, they get 100% of the value. And that means the builder, folks like us, don't take any of that. I don't think that's going to persist over the long run. But bottom line is you then have economies of scale. You're going to have certain teams that are better at it. They have better infrastructure, better funding. There's evidence actually of some block builders who are literally financing blocks. They have negative margin blocks to try to build reputation and things like that. Sort of interesting. But that ultimately, so far, it has appeared that the block building market is working as designed. Validator rewards are going up. MEV extraction is getting more efficient. There are interesting wrinkles associated with things like OFAC control, which is always an interesting subject to talk about. So there's a whole universe of activity happening in the world of block building, and it's something new every single day, as I mentioned.
Yeah. So I guess in the, I cannot tell if time-wise, this is counting down, right? Okay. So we want to talk a little bit about some things. Yeah, so you mentioned some points about parts of improvement. So originally we're building this plane as we're flying it to get to that in protocol PBS, that like very far down destination. Yeah, so you mentioned the centralization of builders. That's common topic of discussion. I think there's a lot of other points that need to be resolved before we get there. So things like, say, payload validation, or are relayers, trusted to a fault? What are your perspectives on these points?
So there are a number of trust assumptions built into block building. Like the builder's going to deliver the payload they said they're going to deliver. Like when the builder says there's this much value in the block, they actually make that payment. And there have been incidents where there are bugs in the system or unexpected outcomes where large payouts are promised that are not delivered, where builders have infrastructure problems, they don't deliver the block, and then the proposer misses their slot. And there are various schemes which are being worked on to reduce each one of those trust points. There is a growing theme right now about if a relay or builder doesn't deliver the block, then they're on the hook for the value of that block, which sounds good, except there's no margin in there. So you're sort of like, why would all these different entities finance the rest of the operation, right? Like, shouldn't there be some economic flow to basically backstop this? So I think these are ongoing debates, and quite frankly, we as Blocknative, and we know the other block builders and relayers, really want to make sure that the marketplace is as sort of fair and balanced and trusted as possible, trusted with a lowercase t, because quite frankly, it's in the best interest of the network and the security of the network for this to operate in this fashion. Otherwise, we risk validator centralization, which again is a much deeper and much more hard to reverse problem.
Interesting. So I feel like we're kind of moving from the design of the block building process over into the design of just like markets in general. So thinking about different ways of improving this market system. So there's this quote by, was it Alvin Roth, about different features that are required for a good market to work. So you need the volume for this market to exist. We need perhaps a trust between the parties in the system for them to want to be involved. And then lastly, the idea that they have access to the system. So maybe let's dive into that trust aspect. So maybe back to Alex. So thinking about bids and how that information is revealed. So do you have thoughts about, right now, we can see all the information that are within a batch. Do you have thoughts about whether that should be sealed or sealed or opened, and what sort of incentives and motivations that provides for the parties involved?
I mean, it's a tricky question, but I think at least what we have right now on Cow Protocol is a sealed version of the batch auctions, and it makes sense to have it sealed because it allows the parties that are participating in this sort of competition or this sort of networks to truthfully reveal what their value for what they have built, in this case the batch, is worth. Because if you then have it open, you can start to play dangerous games of basically just minimally improving what the competition has done, which can lead to worse outcomes than if you actually have it sealed and then you're actually like fully maximizing and valuing what you think this is worth. Like in the case of also of block building, then if you have it open, it can also lead to sort of off-chain deals because you also know who the producer of the block will be, of being like, hey, I'm only gonna increment this little bit of more and I'll pay you like in another way. And then you sort of have this trust relationship built off-chain that it's unfair to the other participants. Whereas if you do have it sealed, then it's a little bit of like, may the best one win, no? The one that gives the most value is the one that truthfully will reveal that.
Okay, so then thanks for the response. So for the last question I have is thinking about what does the DEX experience look like in the future? DEX experience perhaps for the end user more uphill. So in this talk we talked a lot about this MEV, this values rolling downhill from the users down down towards the validators. But with each of the aspects that we've discussed, incrementally pushing that value back uphill for the user. So do you imagine DEXs to manifest differently in the future? What do you have thoughts on that?
Yeah, I think we're very early in the process of mitigating the MEV, or at least sharing it more fairly with the users. So my understanding right now is the current solutions at the application level are mostly centralized solutions. So there's this entire trust, there are all of these trust assumptions at the level of block building, and quite a lot of these MEV reducing applications work in a similar fashion. I think we'll see more of that. It means that the user signs an intent, and then a specialized party, maybe CowSwap solver or backrunning service, they do something with that transaction. They have a privileged knowledge about it, and they can act on that information. They can, for example, extract the MEV themselves and send it back to the users or do something with it. And I think this is the necessary first step. Maybe this will get decentralized later, but right now this DEX, not even DEX, but application experience is all of the attempts are kind of taking over the settlement, the execution. And I think this is one thing that will be big in the future. There will be users that come to those DEXs and they don't want to open MetaMask, click on sign, click on check, select gas, confirm, wait for the validation. It's a very long and very bad UX. I think in the future it will be a bit like TradFi experience, like you go to your website, I want to buy X of Tesla, I click buy, there is magic happening under the hood, and you get your Tesla stock. And it will be similar in crypto. You will sign your intent, and you will let the specialized party take care of your order, extract MEV, settle this transaction for you, and you will get things back without all of that hassle. So that's one thing I'm actually looking into, and I know there are already applications and services trying to work that way. And it's a very big design space of what will happen after I sign my intent. And I think this will develop very quickly, and it has a very big potential in making both MEV go away and make overall users' experience with the blockchain much better.
I think Alex was vehemently shaking his head no,
yeah,
I think,
no.
the centralized.
I do agree. The only thing is like it's a little bit hard if we keep focusing on the extraction part, because then it's just going to lead to perversive games of always having to have this excuse of give me your orders because I can extract the value from you, and then sort of we will create these benevolent dictators, no, that we're at the mercy of like, oh, I'm gonna trade with you because you're giving me this value that like you're extracting for me. And I think the correct way to look at it is rather of how can we actually get rid of this and enforce kind of like a playing field, no, in this case for trading, where MEV is non-existent. And then this way you kind of avoid this sort of game that you're dependent on someone to actually like give you the rebate of your trades. And like at Cow Protocol, this is what we're trying to do, because with the batch actions, like the main root of MEV is that you have one asset with many prices in one block. And that's because there are, with constant function market makers, you depend on the order of the transactions. But if you're able to enforce uniform clearing prices within the same block, within the same batch, then you don't need to order. And then this way, like all the trades that are happening within that batch are non-MEVable. And then in some sort of way, you're not depending on someone to actually have to give you that rebate for the money you're going for. So I think the focus should be more on minimizing, because we keep also forgetting that in the end, as humans, there is a limit to what we can take. And right now, Ethereum is completely, like, in a sense, exaggerating, beating up the users of Ethereum constantly by giving them bad prices. And we're running the risk of pushing these users to other networks that are way more centralized. So it's a dangerous game if we focus on extracting.
And the efforts to be slightly controversial is all MEV bad? And the common thinking is, first off, MEV is unavoidable. It's a fact of life. It can be mitigated or minimized, but never eliminated. You can move it around, but you can never get rid of it entirely. So there's all sorts of things you could do to try to make fair ordering, and all you do is turn it into a latency game. And then you're just worried about how close to the data center you are and how many hops, and then you bribe someone to put your box next to someone else's box because you can play the latency game better than somebody else, right? But the truth is there's multiple types of MEV. One is beneficial. Like, what is beneficial MEV? If you're a collateralized lending protocol and an Oracle update makes a bunch of open debt positions available for liquidation, you need that to happen in an orderly fashion. In fact, our industry has an example of when that didn't happen. Maker, on what was known as Black Thursday, it was a while ago, we did a big write-up on this, was bit by a bug where nobody bid on liquidations, and an entity was able to take $8 million of value for zero cost out of the protocol. And the value of the MKR token declined over $250 million within 24 hours after that. And that was all due to lack of orderly liquidations according to the rules of a protocol. So in the world of MEV, liquidations are a form of beneficial MEV. They ensure, so what you do as a liquidator is you wait for the Oracle update to happen, and you say, oh, the Oracle update's going to happen here. All of these collateralized debt positions are going to become available for liquidation, and I'm going to slot my transaction immediately behind the Oracle update so I can capture that. And guess what happens? There's a competitive set. There's a whole bunch of people who are trying to do that because there's value there. They spread the value around, and it's good for the protocol. It's good for the ecosystem. It's probably not good if you're one of those holders of a debt position that's available to be liquidated, but those are the rules of the game. You got to play by the rules of the game, right? So it's an example of beneficial MEV. Then there's what's known as benign MEV, which is typically arbitrage, where it's sort of victimless. You create an imbalance in price. Someone takes advantage of that. Your settlement isn't adversely affected, but basically price parity is maintained across exchanges. That's good. And then there's, toxic or malicious MEV, typically sandwiching or front running, where you actually suffer less favorable settlement, right? And by the way, now there's much more exotic forms of MEV. There's multi-block MEV, there's cross-chain MEV, there's low incidence MEV. In fact, there's all sorts of interesting dynamics among MEV teams and how they identify these opportunities. And so the net of all of this is part of our ecosystem. Because these are all valid transactions. They're playing by the rules. And so instead, the opportunity is to address all of this at various levels of the stack, at the application level, at the protocol level, and at the infrastructure level. And I think that's what's represented here, all in efforts to make sure users are aware, users are protected, and that the value gets disseminated in an equitable fashion. And I think all of us would admit that the current system isn't very equitable, that basically you have winners and losers, you have haves and have-nots, And if we're going to really be the foundation of the next economy, we need to make sure that this is all handled in a much more equitable, balanced, and intelligent fashion. And that's what we're all working towards. Is that fair?
Nice. Yeah, I think that was a great wrap up. I was wondering, is there anyone in the audience who has questions for our guests?
Hi, what's your take on OFAC and flashbots?
I'm happy to answer. So, okay, quick sort of refresher here. So, U.S. Department of Treasury has OFAC, Office of Foreign Assets Control. They have a list called SDN, Specially Designated Nationals, which basically says U.S. entities can't interact with them. Quite recently, the Tornado Cash Protocol, a smart contract, not a person or entity, was listed. And so there's a whole bunch of open questions as to, can a US-based corporation like us enable transactions involving the Tornado Cash smart contracts, which are OFAC SDN listed. And by the way, this is a criminal regime, and it's on a pure liability. I think there's a name for it, straight liability basis. So basically, you can't say you didn't know. And each infraction carries up to $30 million in fines and up to 30 years in jail. Okay? So you don't OFAC around and find out, period. And so as a consequence of that, there are various players in the space who are filtering these addresses because they don't want to run afoul of these regulations. This is sometimes perceived as censorship. It's sometimes perceived as following the rules. There are various consequences of it, but today, right now, the consequence is it takes about twice as long to get a Tornado Cash transaction onto the network as any other, because about half or a little bit more than half of all blocks are flowing through an OFAC SDN compliant relay. Now, there's a whole bunch of people who are super bummed out about this, who view this as like this big step back. And I would argue that Ethereum has been a censored network from the very beginning. And all you need to do is ask the DAO hack, how'd that go, right? And if you actually look at basically every other chain, if you look at every other system in the world, they all have examples of like certain types of transactions that just aren't allowed. And so it's not that different, but it is an issue and it is problematic because it creates levers of control of what can and can't go on chain from mechanisms outside the ecosystem. And this is generally perceived as dangerous because before you know it, you could have quite a polarized network. And so the good news is there's a whole bunch of work happening right now to basically obviate some of these problems away. Meanwhile, there's also lawsuits going on with the US Department of Treasury to try to get clarification and even potential rollback of this designation. So the actors in the space, including us, really do feel very strongly about providing a credibly neutral network. But there's a lot of gray area to there. Like, imagine you're someone who has strong personal views and you're going to have to confirm a block that contains some hate speech in it. And you just say, well, wait. Is it my personal views are going to get overwritten by the desires of the network and I have to put a transaction on chain that contains hate speech? That doesn't seem very fair. Or my lawyers say one thing and the ecosystem says something else. The ecosystem's going to say, well, we know more than your lawyers do and we're going to get in the way there. Like, that doesn't seem really great. And so I think this is a really nuanced area that requires a whole bunch of nuanced conversation. And the good news is I think a lot of that conversation is happening out there. But it's an interesting area, and again, what makes this a dynamic and fun-filled space.
Did you have thoughts on this?
It's a tricky question. I mean, as a non-American, I can't really speak much of it. If I was American, maybe it's much less scary because of the 30 years in jail. But I would argue that right now with proof of stake, there is a difference back when in proof of work, because before, if I ran a node, I didn't have to choose what relay I was going to do. So then now I am presented with the choice of kind of, do you want to follow the censoring, call like that, but censoring relay or the non-censoring? So it's a bit different scenario than when you're painting than like I want to enforce. Like before, if I was an opinionated person with whatever topic of hate speech, I could simply just not include that transaction and someone else would pick it up. But the thing is that now the vast majority of the transactions are being rejected because they're controlled by the main builder, which is Flashbots, which they're a US entity, and that's understandable, and their lawyers know more for that. But I think it also brings the point of, is Ethereum a US network or a worldwide network? You know, why should the whole protocol follow those rules if we are a true, I guess, censorship-resistant worldwide, network? It's tricky question to answer.
Did you have follow-up thoughts? No. Okay.
It does underscore why decentralization matters, right? Because as soon as you have a centralized entity, you have a point of leverage where other actors can exert control, right? And so this is why we're all so adamant about pursuing decentralization at all layers of the network. And by the way, ensuring fluidity of decentralization, right? This whole thing is, there are some unintended consequences of the block building market. That was anticipated. There was going to be some new stuff that happened. I think this one came a little bit faster than a lot of people expected, but it can also be engineered away. So it's not like, oh, it's the death of the network. Oh, the sky is falling. It's like, oh, yet another technical challenge to overcome. Let's go overcome it. There are very many.
I feel like that question was unavoidable, but thanks for asking the question. Were there any other questions from the audience?
Don't be shy.
Don't be shy. One in the back.
I'd love to hear thoughts on encrypted mempools as a potential solution.
Encrypted mempools.
Oh, I know they exist, and I don't think Ethereum will ever get one. It sounds like a good idea at first. I think Osmosis uses one. And I don't think, in theory, that they have MEV. But on the other hand, if for example, transactions are encrypted, you put them basically in a random order. And economically, it's not always the best solution. You can easily imagine you put transactions in random order because you don't know the contents, and some of transactions revert because they interacted with the same, for example, pool on Uniswap. And if you knew the contents, you could have ordered them so that they don't revert, and both users would be happy. So there is clearly some economic loss to that. It's a choice you make, and I think Osmosis is the most popular one that employs that, and I think they're doing fine. So it comes at a cost.
This is one of these interesting pieces where, you can't ever get rid of the ARB, because the price imbalance is going to exist. It's just a matter of where it shows up, right? So you have an encrypted mempool, so the network doesn't have visibility into what sets of or what types of transactions are going to happen next. But then those go on chain, and everyone goes, up, ARB, right? And now there's a race to get into the ARB, and you go, well, we're going to reshuffle this a little bit so it's randomized. You go, great, I'm going to spam the network. And you go, oh, that's really bad. We got to increase gas fees. And you go, oh, now everybody's suffering, right? I have an idea. We're going to move it to an off-chain auction. You're like, centralize it, right? So these interesting problems of MEV, you can move them around, but you can't ever really eliminate them. And so it's really where you put the edges, not does it go away, or, hey, look, the market's going to dominate, that you're going to have certain protocols, certain applications, certain wallets that are just more economically efficient than others because they handle this stuff more. And users use wallet A over wallet B because wallet A pays me back and wallet B does not. Pretty soon wallet B is losing all their users to wallet A and they go, maybe I should pay my users back too, right? Or my DEX isn't MEV protected and your DEX is, and users migrate to the place where they're getting MEV protection, maybe I should put MEV protection in my DEX as well. So we think that ultimately market forces will determine a lot of this, because at the end of the day, settlement is what matters, and this is very settlement related.
Any other questions? All right. I guess with that, then we'll wrap it up for this conversation for today. Thank you all very much for providing your thoughts. Again, this is an ongoing discussion, so please feel free to grab one of them after the talk, and please give them a round of applause and thanks for your time.